You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Last week, we looked at a couple of trades, and we could also kind of say welcome to the 2018 down day for all the markets. So we've had pretty much a bull market all the way up until today, and I should let you know that we are taping Options Playbook Radio on the 10th of October, so it's 10/10/2018. The markets are closed, and we had one of the biggest down days in 2018. We currently see the S&P 500 index down about 3.5%, or close to 100 points. Let's call it 95 on the day. So we had a pretty big down day, which also means that the volatility index has spiked, which is always normal. So we currently have the VIX index, the SIBO volatility index is worth mentioning, at 22.96. That was up about 7 points today, or almost 45%. So overall, it's been an interesting day. We did a few trades last week because we're nipping on the heels of all these big companies announcing earnings, specifically the FANG stocks. So let's talk about the two trades that we've done over the previous 2 weeks. And then we'll look at a new trade for this week, simply based more so on what has happened today than on any earnings or anything that's going to happen going forward. So let's start by jumping back 2 weeks in time and look at the Costco trade that we did that was going to be centered around earnings. Now, we had looked at Costco. On that day, the stock was at 233, even then some change. We'll call it 233.50 if I remember correctly. And we went out and did a backspread. We were bearish on Costco. We sold the 240 put, and then went 7.5 points down and bought two of the 232.50 puts. All right, so that's a 7.5 point move is what we were hoping in Costco. We thought after earnings it could move more than that. We got that entire trade done for a net credit of around 15 cents if we were able to fill at the midpoint. And we just waited and we sat around on the trade. One thing that we did note is that because we were doing a backspread and time was on our side and we could get it done for an actual net credit, we went out to the October 12th expiration, even though we knew that they were going to announce earnings on the 4th. Time was our friend, and the fact that we could go out a little bit further in time and still get this trade done for net credit at a feasible width between the strikes, we decided to take the extra time. And in this instance, what happened with Costco, the Costco traded fairly flat up until the earnings, and then on the day of the earnings, the bottom fell out, and the market went, on that day, the market went from about 231.68, so it was a little bit down from where we put the initial trade on, and it opened at about 225. So 6 points down, and it continued precipitously down and ended up closing right around 218. So we were looking for about a 7.5 point move. We got a 13.5 point move in the direction of our forecast. So that trade's fairly simple. Close it, take your profit, and run. The biggest question would be, what point in the day do you get out? If the market was down 6 on the open, we're looking for a 7.5 point move. It should have been profitable, mainly because we still had a lot of time. But do you wait until the 10 o'clock hour, the noon hour? And I probably would have got onto this trade somewhere around the noon hour. I don't think I would have rode it all the way to the close and got the maximum. It closed basically at its low for that day, but there you have it. Okay, so one trade done. That was the one we weren't able to talk about last week because the earnings hadn't been announced. And then we did a fancy trade, I guess, if you will, around Netflix, because we knew Netflix was going to be announcing earnings. So we went out and did a calendar trade on Netflix. We bought the month that contained the earnings, and we sold the month that did not contain the earnings. Now that trade is still live. So just to summarize what the trade was, we bought the Netflix October 19th call 400 strike and sold the October 12th 400 strike call, and we did it for a net debit of $7.80. So it was a fairly expensive option contract that we did it on. Well, obviously, if you've been following the markets at all, Netflix just basically fell out of favor today. All the FANG stocks were hit up pretty hard, and Netflix was definitely one of them. So that trade right now, amazingly, is still worth something. We currently have Netflix trading at $325.89. Now, once again, it's 10/10, October 10th. It is a Wednesday. The market is closed. Netflix was down 8% on the day, or about 29 points. So because of the big down movement, though, which was nice on this call, we had a huge up movement in implied volatility. As a matter of fact, from my notes from last week, the option contract that contained the earnings was trading at about 59% vol, and it's currently right now trading at 90% implied volatility on the at-the-money option contract, on the most at-the-money option contract in both cases. So what has happened is that trade is actually worth something. The short month is not, the month that does not contain earnings, but because of implied volatility, we still have that back month option contract trading for about $1 at the midpoint. I'm going to call it $1.35. So the 400 strike October 12th expired. Basically, it's 0 cents by a penny. So we gained any premium there, and we could get out of this trade right now for about $1.35. We have earnings coming out next week in Netflix, and the question is, do you want to stay around or do you want to take your $1.35? And my answer would be take your money and run. And here's the reason why. We just said that implied volatility from last week to this week went from 59% up to 90%. And that wasn't because earnings were coming. That's because of what's going on in the marketplace. So if you hang around, there's a chance that volatility could actually come in on this option contract. And all of a sudden you turn around and that option that's trading for $1.35 is trading for $35. And you lose $1 just because of a movement in implied volatility going into earnings. Kind of crazy. And you're talking about, when we put on this trade, Netflix has already moved 50 points. It was way more than the expected move over the time frame. I think we were looking at 20 points on the long straddle last week. So it went from 377 approximately all the way down to approximately 325. Crazy type move over that time frame, considering they didn't even announce earnings yet. So I would just be happy if I was still in the trade, which I probably would have got out earlier. But if I was still in the trade, I would just take this vol premium and run, because it has nothing to do with time premium whatsoever. It's all about volatility in Netflix. So there's a learning thing. So we had one chicken dinner winner and one trade where we just want to salvage whatever we can and just get out of it and wait for the next week. Okay, so fairly long explanation. We went through 2 trades in detail. Last week was a little bit of a short call. But this week, we're going to look at, well, we have the VIX trading up in the 20s. We have a big down day in the marketplace. We have earnings that are coming. What can we do when we see volatilities increase like this? And my tendency, and one of my favorite trades, just overall, I think you probably know this if you are a follower of Options Playbook Radio, but is to look at butterflies. And specifically, if you're looking for a little bit of that dead cat bounce after the big down day, I like to go to these more expensive stocks. Tesla is one, Netflix is one, Apple is one, and I'd like to do butterflies and just looking for a shorter term bounce. Now, Tesla, not only is the market down, but Tesla's also been beat up. So I think I'm going to stick with that stock. I think an interesting speculative short term play is to do a butterfly in Tesla. And it's just crazy to me, but I went out and before the call today, or before our radio program, I looked at Tesla. Tesla is down $5.92. It closed at $256.88 today, which, all the markets were down. It kind of makes sense that Tesla would be down. It's actually down less than it has been recently, relative. And we can go out and do a October 12th butterfly. Well, remember, it's 10-10, so that's 2 full trading days. You have the 11th and you have the 12th. 10-point wide butterfly with 2 days remaining. The market's at 256. So if we get just the move back from today over the next couple of days, the butterfly with that short of time is trading for $1.90 at the midpoint. So let's set this up. We got the market right now in Tesla at 256.88. We're going to look to buy one of the 260 October 12th calls. We're going to sell 2 of the 270 October 12th calls, and then buy one of the 280 October 12th calls. That is trading for $1.90 right now. So we have a 10-point wide butterfly, and our total cost, which our total risk is $1.90. So our total upside is 10 minus that $1.90, or $8.10. Now, we're not looking to try to make the maximum on this trade because the maximum only occurs right at the middle strike at 270. But we have about, well, if we let's call it $2 for the cost. We're paying $1.90, but let's round it off to $2. So that would make our break evens 262 and 278. So in that instance, we have a 16-point landing range where this trade would be profitable if we can get a little bit of that dead cat balance. And we should get rewarded quickly because Tesla's not announcing earnings, not until the beginning of November. So we don't have any earnings. And if the market does start coming back a little bit, implied volatility should come in. So this on Options Playbook Radio, nothing's ever meant to be a recommendation, but we talk about timing. I care more about what's going on with the volatility, with the overall market, than I care about Tesla. So we have a very inexpensive, low risk, high reward type trade where if we can just be a little bit correct on our forecast, we have a potential to make some money in this Tesla position. Now, if the market continues to slide, obviously Tesla will probably go with it. And overall, you'll be out, but you'll be out $1.90. So just be aware of that and decide for every 1 by 2 by 1 butterfly, you're going to pay $190 plus commissions to do the trade. So that's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com. That's theoptionsguy@invest.ally.com. Thanks for listening, and we'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.